Hi, welcome back. In this session, I want to continue our discussion of trading on information by focusing on insiders in companies. The conventional complaint you get from investors often is, we're on the outside looking in, but there are people inside the firm, close to the firm, who have access to information that you and I don't. Now that's true, right? And in this session, I'd like to focus on, is information on what those people are doing useful to you as an outside investor? I'm going to start with insiders as defined by the law. Those include managers, directors, major stockholders, people who own more than 5% of shares of a company. Legally, these people are constrained from trading ahead of information, right? Ahead of earnings reports, ahead of acquisition announcements, but they're still allowed to buy and sell shares. And to the extent that we can observe when they're buying and when they're selling, is that information that's useful to us as outsiders. I would also argue that there are equity research analysts tracking the company, and while they legally might not be able to access public information, they might have access to information about a company that you and I don't. And by observing what those analysts are doing in terms of revising earnings or putting out buy and sell recommendations, can we trade on that to make money? So we're going to start by looking at both in this session, at least, by focusing on whether insiders themselves make money. And if the answer is yes, then ask a follow-up question. Can tracking what insiders do make the rest of us money? So let's start with a study that goes back a long time. In this study, the researchers looked at companies where insiders were buying, net buys, and companies where insiders were selling. Remember, insiders buy and sell stock. You look at the net amount. So the red line captures companies where insiders were buying. The green line captures what insiders were selling in the months after the insider trade. Seems like a no-brainer, right? In stocks where there's a lot of insider buying do much better than stocks with a lot of insider selling. When the study came out, people said, this is great. We can now make money on this. We'll come back and examine whether that's true. But at least in the aggregate, there seems to be some information here. In companies where insiders are more buyers than sellers, that's good news. Stock prices tend to go up. In companies where more insiders are more sellers than buyers, stock prices tend to either flatten out or go down. Now, in the years since this study, there's been a deeper look at insider trading. And here's what people have found. The first is that insider buying and selling is a noisy signal. What does that mean? In about 4 of 10 stocks where insiders are buying, the stock price actually goes down. It doesn't go up. The same is true for insider selling. And it turns out that if it's a signal, it's a noisy signal. So if you're buying because insiders are buying, be cautious. About 4 times in 10, you're going to be wrong. It turns out also if you focus on insider buying versus insider selling, stronger signal than buying. When insiders are selling, you're far more likely to see stock prices go down than when insiders are buying, stock prices going up. For whatever reason, selling has a much bigger signaling effect. In fact, one study found that insider selling had companies where there was a lot of insider selling at stock returns of 14.4%, significantly lower than the 22% you had in firms with insider buying. And the insider trading effect is much greater at small firms. We'll come back and talk about why that might be. But if you see insider buying at a small firm, it's much more likely to be followed by a stock price rise than if it's at a large firm. Noisy signals, selling is a stronger signal than buying, at least on the part of insiders, and much stronger at smaller firms. So let's update many of these studies because insider laws have shifted and tightened over time. The SEC has become much more expansive in its definition of what comprises insider information and more aggressive in its enforcement of those laws, though it's selective. Companies are also much more restricted in what they can share with investors. There was a time where companies could call in 20 equity research analysts that tracked them, gave them information that the rest of the market did not get. That's no longer possible. In fact, Regulation FD, which was passed in 2002, effectively made it much more difficult for companies to share information with some investors and not with others. One of the things we've discovered in the studies is the effect of insider trading seems to have become much smaller since. Now remember, all these studies of insider trading focus on legal insider trading. And by making it more difficult for insiders to trade, by defining insider information more stringently, you might have taken away the profitability of insider trading. Now, of course, as outsiders, you're not a director, you're not a manager, you're not a person who owns 5% of the shares in a company, you're not an equity research analyst. We'll talk about analysts later in the next session. So can I make money by looking at what insiders are doing? At first when you take your first look at the insider studies, it looks like you do. In fact, the early studies looked at the returns following when the insider reporting date was, because insiders have to file by a particular date. It took that date and said, what would stock prices do? And you can see if you bought stocks after insider buying reporting dates, stock prices continue to go up. But then researchers realized that the insiders report to the SEC, it's not the date where that information becomes publicly disclosed. If you take the actual public disclosure date, that's the official summary date, and you look at the returns thereafter, there's almost nothing. So the bottom line is, knowing what insiders are doing is more valuable if you knew it in time, if you knew it when they filed. But since you don't know it till 3, 4, 5 weeks later, it turns out that you can't make much money on it. So should you look at what insiders are doing? Absolutely. Can you make money on it? I'm not so sure. In fact, as you go to online disclosures, that period between the reporting date and summary date is compressing. But the consequences are not changing. After it becomes official, it becomes much more difficult to make money on insider information. Now, digging deeper into that insider trading research, it turns out that not all insiders are equal. Because you can have a small manager who buys 100 shares, and you can have a CEO who buys 1 million shares. And this shouldn't come as a surprise. Large trade made by top executives have a much bigger pricing impact and create excess returns than small trades by lower level executives. And as investment alternatives to shares become more available, options and perhaps volatile options is the first stop, futures on stock, it turns out that insiders might do their trading there rather than in the market. So you might want, as an outside investor, you might want to track trading in that market. And one way you can track it is by looking at trading volume. If trading volume on call options on a stock jumps, especially if it's a lightly traded stock, it might be because insiders are trading on those call options. So it is clear that insider trading has an effect, but whether you can trade on that effect is much more diffuse. Finally, insider trading information is more useful in some companies than others. And we talked about small companies versus large companies. Let me generalize. In companies where information is plentiful, there are 50 analysts tracking the stock, hundreds of news stories, knowing what insiders are doing is much less useful than in small companies where there's far less information, far fewer analysts following it, far fewer news stories. So if you're going to track insider trading, the payoff might be great if you track insider trading in small and below the radar companies and in the large cap companies. One of the questions we haven't examined in this session, and perhaps for a reason, is almost all of the research on insider trading is on insiders who report. The insiders who report to the SEC are the insiders who follow the law, don't trade ahead of information. But insider trading, which is illegal, is not going to get reported to the SEC. And we know conclusively that kind of trading, you know that your company is going to be targeted in an acquisition in a couple of weeks, and you find a way to trade ahead as the investor in that target company in the 2 weeks before, you're going to make a ton of money. It is pervasive. And the reason we know it's pervasive is because before big announcements, and we'll come back and talk about it in the context of acquisition, there is a drift in the price. So if it's a good news announcement, the price starts to drift up before the actual public announcement. I'm cynical. That tells me that there are people trading out there. So illegal insider trading clearly makes money. But perhaps the risk you've got to factor in there is you could get caught. And if you're trading on an illegal insider information, timing is key, right? You got to get in at the right time, get out at the right time. So essentially with insider trading, as with every other information aspect of information trading, that aspect of when you get in and when you get out might determine whether you can make money on the trading. So let's summarize what we know about insiders. In the US, for decades now, insider trading, if you trade ahead of information, is illegal. But if you trade just based on general views on a company, you can buy and sell companies. And you got to file that you've done that with the SEC. The SEC makes it public. The research is mixed. If you look at the, whether there's a drift in the price, at least in the cross section, it looks like insider buying is followed by company stock prices going up, and insider selling by company stock prices going down. But as outsiders, you might not be able to make money on it because by the time that information becomes public, almost all of the effect is incorporated in the price. As for illegal insider trading, all bets are off. Those guys make money. But since it's illegal, there is going to be no SEC filing, and it's going to be difficult for outsiders to track that it's happening, with a caveat, which is you might be able to guess there's illegal trading going on by looking at trading volume or looking at action in the options markets, because that's where illegal insiders will go to trade. One final point. There are markets out there, now the geographies of the countries, where managers and insiders are allowed to not just trade, but to provide information to a subset of outside investors, analysts, institutions. In those markets, those investors have an advantage over the rest of us. The downside is, though, by giving that advantage and excess return, you create the perception, and the perception is based on a reality. The markets are not fair. What that effectively does is it means outside investors are less willing to partake in those markets. So many of those markets, there's a lack of liquidity, and people complain about the lack of liquidity and people not wanting to participate, but who can blame them? If you've created a game where you've tilted the game in favor of insiders and people who are close to insiders, of course outsiders will not participate. So as you look across markets, there might be markets where inside information is legal for you to trade on. And if you can become one of those insiders who can take advantage, all the more power to you. But those are also going to be markets where your transactions costs are higher. The price impact is going to be much larger. I hope you found this session useful, and I thank you very much for listening.